Well, we'll start with the earnings. It's a little bit less of an issue, Mike, actually, because if you think about it, this quarter is shaping up a lot like the last reporting quarter in July and August, which is part of the reason that you've had this rally. We know downgrades were coming. They arrived. And in fact, the last several days have seen a little bit of stability to those earnings downgrades. But again, it goes back to this entire thing. And today is a perfect microcosm of the fact that, the Fed basically came out sounding more hawkish than expected. You had the move higher in bond yields. You had the stronger dollar reaction. And of course, in this year where you've got an almost perfect correlation between stocks and bonds, you had the sell-off led by the more yield-sensitive growth sectors. And to us, it's the right time of the year to expect that to come to a halt and perhaps have a rally, continuation of this bear market rally. But we still have some uncertainty to get through, again, the reverberations of the Fed and the elections next week.
The elections next week, and yet that's something that people have been putting in the bear category, the bull category, in terms of once you get past it, historically it tends to be a pretty decent little trigger for a year-end seasonal strength. The other thing I wonder if people are going to be pointing to is, look, we're talking about a retest of the lows. It wasn't October, a retest of June. We haven't gotten downside momentum from there. The volatility index was actually down today after we got past the Fed.
Yeah, it's interesting because when you think about the volatility indices, all the volatility itself is actually being felt in the fixed income markets. Extremely unusual. And for us, when you think about a year like this year, the ups, the downs, the roller coasters centered around these macro relationships, you mentioned that it is our view that you're likely to get a new bear market low at some point in the next 6 to 12 months. But given the volatility that we see and the potential for a cessation in the uptrend in yields sometime as the Fed backs away, they will eventually back away, you could actually get a good market next year because history says that post-midterms tend to be very good for stocks, among other reasons.
And how would you, tactically navigate around these issues right now in terms of the kinds of things to emphasize? If you think yields are about to peak or in the process of peaking, is that speaking in favor of fixed income or bond-like stocks, or is the cyclical trade still okay?
So we do think yields are interesting here. This is the first time we've felt good about longer duration since 2019. But that having been said, if you think about it again, the Fed will continue for a time pushing up the short end. At the same time that even though inflation is going to start coming in a little bit, it needs to, that is still elevated inflation, good for the value trade. So we think there's a bit more room in terms of value outperformance. Financials, healthcare, energy has obviously been a standout the entire year. Interestingly enough, it still trades cheap on 2023 projected earnings. So for us, that's where we see market leadership evolving.
Big picture, Julian, if you do think that there's a pretty high likelihood of further bear market lows, we've been in this for, let's say, over 10 months in terms of when the markets and when valuations peaked. If we're getting lows maybe sometime into next year, is this going to start to look and feel like one of those prolonged multi-year bear markets like in the early 2000s or to some degree 08, 09?
We don't think it's 08, 09, simply because there aren't the stresses in the financial system by any stretch of the imagination. And it's not 0002 because you don't have, although, growth is arguably still overvalued relative to value, it's not nearly the extremes that we saw. So from that perspective, the PE compression that we've seen this year has really done a lot of damage or corrected a lot of the excesses. Now it's more of a wait and see as to whether we are going to get that recession that the majority of the people that we speak with believe you're going to get. Ed Hyman views it at basically a 50-50 probability. If you get that recession, there is a further leg down. But as a long-term investor, you need to be prepared to buy down another 10%. and then another 10% after that, because frankly, you've been rewarded for 40 years doing that, and we think that mantra continues.
Yeah, and when the turn comes, it often is quick at the beginning, so we'll see how that plays. Julian, thanks a lot. Appreciate it. Good to talk to you.
Thank you.